Welcome to another exciting episode. Today we're going to take you on a journey into the world of the wealthy and their tax secrets. But before we dive into this, we need your support to continue creating content that informs, entertains, and unravels mysteries. So please don't forget to like, share, and subscribe to our channel. Your engagement fuels our efforts to bring you more intriguing insights into the world around us. Now, are you ready to unravel the tax evasion enigma? Have you ever wondered how the rich seem to pay less taxes than most of us? It's a question that has puzzled many. This enigma, often termed as tax evasion, is frequently associated with the affluent. They've mastered the art of keeping their hard-earned money away from the taxman's reach. In this video, we'll delve into 15 intriguing methods that the wealthy employ to sidestep taxes. From offshore accounts to shell companies, from trust funds to real estate investments. Let's unravel the mystery of these millionaire tax secrets. First up on our list, the infamous offshore accounts. Now, this is a classic strategy used by the wealthy to sidestep their tax obligations. Picture this: billionaires and millionaires funneling their money into accounts in tax havens like the Cayman Islands or Switzerland. These countries have strong bank secrecy laws, creating a perfect environment for the rich to stash their wealth virtually undetected. By placing their money offshore, they effectively reduce their taxable income. How so? Well, these funds are often not considered taxable until they're brought back into the home country, if they ever are. In the meantime, they can grow tax-free, increasing the wealth of the account holder without a penny going to the taxman. But remember, while these practices may be legal, they're widely criticized as they contribute to income inequality. It's a game of hide and seek with the tax authorities. Next, we have shell companies. These are entities that exist on paper but don't engage in any real business activities or have any significant assets. They're like empty vessels waiting to be filled. But here's the twist: these empty vessels can be filled with vast amounts of wealth. Shell companies can be used to hide income and assets from tax authorities. They're also widely used for money laundering. You see, the money that flows into these companies can be difficult to trace back to its original source, making it a handy tool for those wanting to keep their wealth under the radar. Imagine you're playing a shell game on the streets of New York, but instead of finding a pea under a shell, you're trying to find billions of dollars. It's a complex and secretive world, often hidden in plain sight. A shell game of a different sort, wouldn't you agree? Third on our list, trust funds. Now, these are not just for the beneficiaries of wealthy families, they are also a clever tool for tax avoidance. Here's how it works. Trust funds allow the wealthy to transfer their assets, including money, property, and investments, to their heirs in a tax-efficient manner. Picture this: a billionaire can put a sizable chunk of their wealth into a trust fund, which then legally belongs to the beneficiaries. The twist? The billionaire still controls the wealth and can even benefit from it while alive. And here's the kicker: when the time comes for this wealth to be passed on, it's not subject to the usual inheritance tax. This is because the assets were technically never owned by the billionaire but by the trust. The result? Passing on wealth without passing on the tax burden. Real estate investment and equity swaps are also popular strategies. Now, you might be wondering, how on earth can bricks and mortar help with tax avoidance? Well, the answer lies in the tax benefits that come with real estate investment. Imagine for a moment that you've got a wad of cash. You could put it in a bank where it would accrue interest and consequently interest tax. Or you could invest it in a property. The value of that property could increase over time, just like interest. But here's the kicker: you don't pay tax on it until you sell. And even then, there are ways to minimize the hit. For instance, if you lived in the property for at least 2 of the 5 years before selling it, you can exclude up to $500,000 of gain from your income. That's quite a tax saving, isn't it? But let's say you're not into real estate. Maybe you're more of a stocks and shares kind of person. Well, don't worry, there's a tax avoidance strategy for you too: equity swaps. An equity swap is a financial agreement where two parties exchange the gains and losses from two assets. The assets are usually a fixed interest rate, like a loan, and a set of equities, like stocks. Here's where the tax-saving magic happens. By swapping the gain from your stocks with the gain from a loan, you can effectively avoid paying capital gains tax. The swap is seen as a derivative rather than a sale, so it doesn't trigger the tax. But remember, this isn't a get-out-of-jail-free card. The IRS is always watching. And if they suspect you're using these strategies for tax evasion rather than tax avoidance, you could be in deep water. So whether you're into real estate or stocks, remember this: there are legitimate ways to minimize your tax bill. All it takes is a little knowledge and a lot of savvy. Bricks, mortar, and stocks, all tools in the tax avoidance arsenal. Philanthropy and insurance policies can also play a part. Let's delve into this. Philanthropy, or the act of giving, can be a tax-saving strategy. When wealthy individuals donate to registered charities, they're often entitled to a tax deduction. This reduces their taxable income, which in turn decreases the amount of tax they owe. This strategy isn't just about saving money, it also allows the wealthy to support causes close to their hearts while enjoying tax benefits. Now, let's talk about insurance policies. Certain types of insurance policies like whole life insurance can serve as tax shelters. The premiums paid into these policies grow tax-free over time. When the policyholder passes away, the death benefit is generally tax-free for the beneficiaries. This way, wealth can be passed on to the next generation without being eroded by taxes. Doing good or just looking good? The line can get blurry. But either way, it's clear how philanthropy and insurance policies can be employed to mitigate tax liability. So there you have it, 15 ways the rich avoid taxes. We've traveled from the enigmatic world of tax evasion to the murky depths of offshore accounts. We've unraveled the shell company's mystery, peeked into the labyrinth world of trust funds, and explored the intricate realm of real estate investment and equity swaps. In our journey, we've also discovered the dual-edged sword of philanthropy and the protective shield of insurance policies. These are the tools of the trade for the wealthy, the strategies they employ to hold on to their riches. While it's crucial to remember that many of these tactics are, in fact, completely legal, they do raise some ethical questions. After all, if the rich are exploiting these loopholes to pay less, who shoulders the rest of the tax burden? It's a question worth pondering. But let's not forget, these strategies aren't exclusive to the ultra-wealthy. Some of them can be used by anyone. With the right knowledge and guidance, it could be you using these strategies to maximize your wealth and minimize your taxes. In the end, it's all about understanding the game. As they say, knowledge is power. So, equip yourself with this knowledge and play the game to its fullest. Remember, it's not what you make, it's what you keep. And for the rich, that often means playing a different game when it comes to taxes.